Trump is exempting phones, computers, and chips from the new tariffs. Now, if you've been keeping up, this guy smacked 125% tariff on China. And he's like, you can't import nothing into this country no more. It is what it is. And now he's like, okay, wait, hold on. But you can bring the technology. It's okay. The chips, the flat screen TVs, that's okay, but nothing else. Now, obviously, Apple is going to be happy about this because they were about to be eliminated from the planet, right? They were about to their hands were tied. They're like, bro, our company is in your hands, Trump, like 125% tariffs. We ain't getting no iPhones this Christmas, right? So they're happy about it. But the question is, what about for investors, right? And that's what I'm going to talk about in this video. Let's go into the deeper perspective of my theory of what I believe is going to happen to the market. Now, this is not financial advice. You do what you want with your money, but I want to show you what I'm doing with my money. So just to be clear, this is not like random fluff news. This is actually real. He's excluding a lot of technology, including smartphones, laptops, memory chips, semiconductor manufacturing equipment, flat screen TVs, tablets, desktop computers. They're all exempt, okay? All those Chinese imports, all of that equipment, it's exempt from the 125% tariff that Trump is putting on China. This is real and it's significant. As you can see, 55% of all of the total imports from China are technology. So this is a big exclusion. It's not a small exclusion. This is huge, right? A lot of relief on this tariff pressure. And it really just shows kind of a little bit of flip-flop nature back and forth of Trump like threatening people and then seeing how the market reacts and then relieving it and It's like this volatility, which I believe is uncertainty in general. So we could get like a little relief rally, but I don't think it's sustainable. Hence the title of this video. Don't get finessed. If I were to explain it like from a story perspective, it's basically like you're driving a car. The engine is smoking. There's fire in the engine. And then somebody just turns up the music in the car and plays like really loud worship music and just distracts her. Oh, everything looks great. But at the end of the day, underneath in the engine, there's a lot of issues that are persisting right now that Trump has to deal with as a president. Band-aid solutions and hype only trick the everyday person. It's marketing gimmicks. But what's going on under the hood? Like what is actually going on? And I want to talk about the credit system and how I believe this is the most significant variable for our economy, especially risk-on assets like crypto and stocks. Like right now, crypto and stocks will be affected by this credit system. And there's kind of like this tariff thing going on. The tariff thing was putting pressure on the credit system. And this is why I believe Trump is taking a step back. He's realizing how catastrophic this tariff policy was. The entire market dropped substantially. And now he's going back slowly but surely on his word to a certain extent. I don't know for sure. I don't know all of the details, but what I do know is he got extremely aggressive and he's like, oh wait, hold on. 90-day exemption. Oh wait. Oh, but China, the 125 that we were aggressively attacking you with, you can bring 55% of everything you import. We'll exempt that. You're good. But do you see what I'm saying? Do you see what I'm saying? This one chart right here really exposes everything. So I want to go over in great detail slowly. For someone that doesn't understand anything about math, I'm going to break it down for you. You're going to understand it after this. And this is my main investment thesis. This is kind of the core of why I've been so bearish. And this is even before the tariffs, by the way. I've sold before the tariffs. So I believe that this chart right here even has some type of prediction qualities of these like crazy events like tariffs or like black swan events. This could predict that. And I'm going to go into extreme detail about it. But first, you have to understand the dynamics behind it and why it's important. If I just throw up a chart like a lot of people do on the internet and I don't explain to you why it's important, well, it's just a chart. So what is this? What we're looking at is the S&P 500, which is a basket of the top 500 assets on the stock market, right? Top 500 companies, right? And the bottom is the federal funds rate, which is interest rate policy. Now, we're going to understand the dynamic between them because the S&P 500 is basically like saying crypto. This lines up directly with crypto, almost identically. And I'm even gonna show you this chart in comparison to cryptocurrency specifically. So let's go into what interest rate policy is. So the first thing you have to understand is the federal funds rate. So the federal funds rate is controlled by the Federal Reserve. The Federal Reserve is kind of like this private weird corporation thing that controls all of the money in our economy. The government does not control it. Trump cannot control this at all. He has no jurisdiction into the Federal Reserve at all. It is completely separate. He cannot say anything about interest rate policy, right? So it's like this weird private corporation that was created by all of these big private bankers, including JP Morgan, right? And they control the federal funds rate, which is an interest rate that banks charge to each other overnight. The FOMC, or the Federal Open Market Committee, adjusts this rate to control the economy. Now, the next time we're having a meeting is over here in May 6th to 7th. So next month, we are going to have a meeting and they're basically going to come out and say, okay, interest rate policy is going up, down, or staying the same. Now, this one variable, I believe, controls the entire economy, and it is the most important, the cream of the crop above every indicator, signal, metric. It is the most important variable for risk on assets like stocks and crypto. It controls all of crypto on a longer time horizon, not on a daily. On the longer time horizon, it controls all of crypto trends, and I want to prove that in this video. So let's go through the process a little bit. So when the Federal Reserve lowers interest rate, right? Just think about it, right? So let's say hypothetically, I don't know, you want to loan your friend $1,000 at 5%. That means he has to pay you 5% back, right? So when they lower interest rates, that means that banks can borrow cheaper, meaning like if they lower it to 1%, now you can borrow way cheaper, right? And more lending happens. So the banks are like, okay, we can borrow for cheaper, so we're going to actually loan out money to people, businesses. We're going to do it way more aggressive. We're going to loan out way more money because we're getting it for cheaper. So like they're borrowing it and loaning it out to other people, right? So loans increase. There's more money, but not real money. There's credit-based money. And this is the difference. And this is, I'm telling you, there's a lot of people showing you guys like the M2 money supply, and they're always talking about liquidity. They're wrong, okay? Liquidity is important, but this is way more important. This is above the liquidity. So it's not real cash. It's debt-based money. And it only exists because somebody owes to it, right? So the supply of credit goes up, spending goes up, and asset prices go up, meaning they drop interest rates. There's a whole bunch of loans being taken out. People are taking out debt. They're buying more houses, et cetera, et cetera. And all of these assets, risk on assets like crypto, the stock market, they go up. Now, it's not exactly like that. There's a timing kind of explanation that you'll get in this video. Like the timing is everything. Okay, it doesn't work like that perfectly. But in general, that's how it works, right? So when the Federal Reserve rises interest rates, borrowing gets more expensive, credit slows down, there's less money that flows into the system, spending drops, and asset prices fall, right? Businesses come back, unemployment rate, recession risk increases, right? There's just less credit in the system, so people are not taking on risk, right? The economy runs on credit, not cash, and I'm going to show you that right now. But first, let me explain to you all these other metrics, right? Because you see unemployment, you see the CPI, you see the M2 monetary supply, all these things, and people talk about it, but they are all byproducts of the interest rate policy. For example, inflation is usually defined by the CPI. You've probably seen this before. There were some recent numbers that dropped like 2 or 3 days ago, right? And this is the actual mathematical formula, right? So this is the CPI inflation rate equals this month's CPI minus last year's at the same month, right? So it's not even the CPI, it's the rate of change on the CPI. And this tracks a basket of goods and services. So when they say inflation, they're not even talking about the monetary supply inflating. They're talking about the cost of goods going up. So there's like, they basically take like a whole bunch of goods and they put it in a basket and they create one number based off of that basket of goods. And if the basket of goods is going up, that means inflation is rising. It's the cost of goods. And it's a lagging indicator. It reacts after credit has already expanded or contracted, okay? Hear me out. It's a lagging indicator. We have to find predictive indicators, not lagging indicators. I've even heard of people referring to the DXY. So for example, the DXY is the dollar's strength on the world, right? And this is measured by comparing the dollar to other foreign exchange currencies. So when rates rise in the US, dollars become more attractive and foreigners buy dollars because there's less credit in the system. And this is not exactly perfect. This is just kind of like dynamics to explain it to you, right? But when rates drop, dollars are less attractive and the DXY drops. Again, not a perfect formula, but this is meant to show you that, again, it is all based off of interest rates, not the strength of the dollar. The strength of the dollar is a byproduct of interest rate policy. If we had a finite supply in America, I just want to add kind of like my 2 cents on this. If we had a finite supply, meaning there was a limited supply of US dollars and there will never be more printed ever again, which is not the case at all, right? This is not the case, right? Then that means the DXY, in my opinion, would have more relativity to the S&P 500 and risk on assets. I would take it more serious. But being that there's an unlimited supply, the dollar's strength is pretty much irrelevant. It's the credit system. I'm telling you, it's before. Again, dollar strength is reaction. Interest rates control capital flows, and that's what we're looking for. We're looking for the faucet. Where's the the money coming out of the faucet? That is what we're looking for, not the byproduct. I'm looking at the faucet because that will give us our predictive metric. So let's go into an overview so you understand this dynamic. You really have to understand it. It's one of the most important variables, right? So the first thing is the Federal Open Market Committee, right? The FOMC sets interest rates controlled by the Federal Reserve. This changes the cost of borrowing for banks, which affects how much credit banks issue to people. Listen, right? Listen, the vast majority, like if you buy a house, the majority of your money is being spent in credit, it's being set in credit. You're not buying a house cash. Most people are not buying a house cash. So credit is a big portion of someone's life, right? Number 4, there's credit expansion and more debt-based money enters the system, not legitimate money. This is where people make huge mistakes. They think that the actual cash is the thing you should be looking at. That is not the case. If you look at every economic crash, the dot-com bubble, the housing market crash, and COVID, it was all credit-based. It was all credit-based. It wasn't like the M2 money supply. No. It wasn't like global liquidity. No. They are all like literally after this. That's what I'm trying to explain to people, right? More spending equals higher asset prices eventually shows up in CPI inflation, and inflation data influence public sentiment and policy reactions, right? By the time inflation shows up, this is why this data is so irrelevant. The credit cycle is already in motion. Everything is a byproduct, including the liquidity in the system. Listen to what I'm saying. Everything is a byproduct of credit. The banks use credit. And I'm going to boil it down to a fundamental belief that I have. So this is not taken from like any like data. I'll show you what I'm saying. So right here proves what I'm saying. The M2 money supply, as you can see right there, is 21 trillion, but the total credit and debt market is about $50 trillion. It is literally bigger than all of the money we have right now. Like literally the credit system has more checks and balances and more fake dollars than our actual fake dollars. Right? So this is what I'm trying to explain to you guys. It's not all about liquidity when you understand it's dynamic. It's the thing that makes the liquidity start, right? You have to understand this. So this is my fundamental belief of why I believe, and just bringing it back to timeless wisdom from the Bible, right? The borrower is slave to the lender. So if you think about society now, it's all just these power control vehicles, right? It's everybody trying to control somebody, right? So like whoever these elite are, they're trying to, I don't believe they have ultimate control, but in the physical realm, in the physical world, the spiritual is different. In the physical world, the devil has control over the physical world, and he uses this to enslave people. Back in the day, they used to physically enslave people and force them to go build, like, for example, a monument, and they would like wage war on like a nation right next to them, take their people and be like, hey, go build something. Right? Now we are enslaved through money, specifically through debt, right? And even more specific, through the interest payments. For example, if I take a $10,000 credit card, right, and it's like 2% interest, they do not want me to pay off the $10,000, because if I pay off the $10,000, they stop getting interest payments. So they're going to do everything in their power. These people do not want the debt to be erased, because that means that their interest payments are dead. Are you catching what I'm saying? No, nobody wants the debt to be paid off. Like in the background, they don't, because that means that they get no more interest rates. That means that they lose power, right? They lose the power over the slave. If you want to be truly financially independent, pay off all your debt. If you want no attachment, if you want your money to multiply, pay off all your debt, right? This is the way it works. As a fundamental belief. It's an invisible chain. So for example, what they do is they're like, okay, they have the power, right? Just think about the Federal Reserve. They have the power to basically increase the credit or decrease the credit at will, right? So what they want to do is they want to make the credit cheaper, then other countries and other people take out more loans, they get put in more debt, and they get more interest payments. And they just keep doing that. They want literally as many people as possible, okay, listen to what I'm saying, to take out as much debt so that they can get never-ending interest payments. And as soon as the person actually pays off the debt, they are free from this chain of bondage. So again, this is proving what I'm trying to say, which is credit is the most useful vehicle for enslaving people to get them into doing things that you want to do through human labor. And then being that you have all this debt and you can't pay this and you can't pay that or whatever the case is, you have to work, right? Are you catching what I'm saying? It's like the cream of the crop, the tip of the iceberg of all financial markets. Which brings us to this final conclusion before we go into the chart. Right now, the United States government is enslaved to the Federal Reserve. That's how it works. I know it sounds crazy. This is a private company. Trump has no control over this. They're enslaved to the Federal Reserve. The United States issues treasury bonds when it needs money. So the United States is like, I need money. I'm going to issue treasury bonds. And the Federal Reserve buys those bonds, becoming the lender to the government, right? So the United States owes the Fed, but the Federal Reserve returns most interest payments back to the Treasury. So essentially it's like the Federal Reserve increases borrowing, right? They increase the credit in the system. The United States is enslaved to that. Banks are enslaved to that, right? And then we are enslaved to the banks. And it's like this chain of reaction. And you'll see what I'm saying. One of the most predictive indicators in the market. And this basically moves the entire risk-on economy. When it comes to stocks and crypto, this moves everything. Let me show you. So as you can see right here, this is the S&P 500, the original chart I was showing you. And this green line, look at this green line. I'm going to pull this up a little bit. Look at this green line. This is interest rate policy. This is the federal funds rate. This is what I'm talking about. So I put the green line at 2% interest, which is very low. Now we're currently sitting at 4.33. As you can see right there, that purple line, we're currently at 4.33. I put it below 2%. Now, if we look at these big bull cycles, look at this. Look at this increase in the stock market, right? Look at this increase. Increase in the stock market. Look at this increase. I put them in, and it increased all the way to here, but I put them in this square because this white square pretty much shows when interest rates were low. Look, credit is cheap here. Credit is cheap here, and credit is cheap here. And look how it started every bull cycle. It was the beginning of every bull cycle. Since like 2000, in the modern, age, we have this type of dynamic playing out. Not only that, but when they started dropping credit, look, when they started dropping credit, right, the interest rate, this predicted all the crashes. This was a crash. This was a crash. And this was a crash. Not dropping credit, but dropping interest rates. That's what I meant to say. When they started dropping interest rate, this was a predictive factor. Because think about it. Interest rates are high. Everybody's wondering, okay, like when are they going to drop interest rates? Once they start seeing signs that interest rates are about to be dropped, they're like, okay, let me get my money out because I know eventually it's going to go down to zero, right? And this was a predictive indicator. Look at the red circles. Every time this dropped the market. This was COVID. You don't see it. If I zoom in, you can see it. But this was COVID. That dropped the market as well, right? So, in general, for a bull market to happen, we need the credit cycle to restart. And the credit cycle doesn't start without a crash. According to history, since 2000, right? This right here was the dot-com bubble. This right here, let me say it again, this right here is the housing market crash, right? And this right here was COVID. And all of those crashes dropped interest rate policy down to zero. So it was basically like the Federal Reserve was like, okay, you know, interest rates are high. Look, right here, this is the story. Interest rates are high. They gave a little indicator. They're like, okay, we're going to drop it from 5% to like, in this case, it was 6%. They dropped it to like 5.25. And then everybody freaked out. And everybody was like, all the smart guys with a lot of money, they're like, oh, snap. The Federal Reserve is now on a downward trajectory with interest rate policy. So, you know, I'm going to wait. I'm going to wait for the 0%. This crashed the market. The anticipation for credit going to zero crashed the market. Everybody started pulling their money. It crashed the market, right? Here again, Federal Reserve starts dropping interest rates a little bit, and everybody anticipates that, drops the market, and then the Federal Reserve, right, has to react to that. So the market's falling so bad, right? So they dropped it a little bit, then the market falls so bad that as a reaction, they're like, okay, emergency, emergency, the market's falling. Let's drop interest rates to 0% so people could take out more loans, which is exactly what they want. They want interest rates to go to zero because if they drop it to zero, and it's not exactly zero, it's a range. They drop it to like 0 to 0.25. That means that people will be more enslaved. That's what that means. People are going to be more and more enslaved. So they drop interest rates down to 0 or 0.25 or whatever the case is, which you see here, and everybody starts taking out more loans and they start buying things that they can't afford, whether it's cars, houses, stocks. They start taking out more loans and buying things they cannot afford, right? You can see it right here. Low interest rates start every bull cycle. I'm going to blow your mind even more. We have never seen, this is Bitcoin's price. We have never seen a bull market in Bitcoin with high interest rates. This is since the beginning of Bitcoin, right? Right here is a high interest rate environment. This was the bear market of Bitcoin. Right here is the only time we've seen anything that was even slightly bullish. Anything that was slightly bullish right here. This high interest rate environment is the only time we've seen this. And so it is very sketchy. we have no evidence of any crypto bull cycle ever in a low interest rate environment, except for what we experienced this first year. So in general, I don't look at Bitcoin because it's such a small chart. If we look at, in general, risk on assets like this, right? In general, this, in my opinion, it just lays everything out. It just lays everything out. So the tariff policies are pretty much irrelevant. The tariff policies are like something that's very short-term stuff. You can't predict Trump's behavior and mood. We can't predict if this day he's going to feel aggressive towards China or this day he's going to relieve it from China. We don't know. But as a longer-term time horizon trader, I am not an investor, but I do trade on longer time horizons, and we're going to talk about that towards the end of this video. I do believe, right here, look, according to what we see right here, look, this predictive, look at this, the red circles, this predictive pattern is playing out. And look at the top. So I do believe there's going to be a crash, just to give you kind of a final prediction. I do believe there's going to be a crash, and then the Federal Reserve will drop interest rates down to 0% as a reactionary measure. Everybody will start taking out more loans again, and then we'll go into the greatest bull cycle ever. Now, this is not a bad thing. Why? We have the 4-year halving cycles for Bitcoin, right? This is 4 years, and this is great. Every 2 years, we can make a whole bunch of money, right? Technically every 4, but there's a 2-year bull run and a 2-year bear run. So that's why I say every 2 years. So the 4-year Bitcoin halving cycle is amazing, but the credit cycle is even better. Why? Because every time, and let me pull this chart up here, every single time they have dropped interest rates to 0, which is like right here, we had very long bull cycles. This is a 2,253-day bull cycle. Look, when they drop interest rates down to 0, look at that. It starts everything. Look at how long this bull cycle was. 4,000 days. When they drop interest rates down to 0, we have no problem making money. Look, interest rates down to 0, big bull cycle for 1,700 days. So this is actually a really good thing as long as you could detach yourself from the money. Because if they do have this crash and the credit system gets reworked, ain't no 4-year bull run. We could experience a very prolonged 3 to 7 year bull run, right? And that's what I'm trying to explain to you guys. It's not a bad thing. You just got to be careful, right? You got to be careful with your money and invest at the right time. And this is what I've been trying to say over and over again. The credit system is more important than any type of short-term Trump news. I don't trade based off of news, bro. I don't. The market is uncertain. Nobody knows what Trump's going to do. And at the end of the day, Trump is not in total control. The Federal Reserve is in total control of the risk on market. All right, so to finish off this video, I want to explain kind of my thought process. So me personally, I am a position trader. I trade over longer periods of time. So an investor pretty much never sells. They're selling maybe 5, 10, 20 years. They're like hardly ever selling. But as a position trader, I trade over like 6 months to like 2 years time horizon. And the reason why I do this is very clear, by the way. The reason I do this is because we do experience, I am a crypto trader. We experience 2-year bull run and 2-year bear markets. So I don't hold bear markets. I don't hold it, right? And so to me, the credit cycle is the biggest. Then the 4-year Bitcoin halving cycle is like right under that, right? So from a crypto perspective, we are technically in a bull run, but crypto is not in an isolated vacuum. The credit cycle is above the crypto cycle, right? So the main point I'm trying to make is, look, this whole debate of if you could sell or buy or whatever the case is, some people want to hodl. Look, bro, have peace with your decision. But just know that if you're hodling, you are moving like an investor. So you can't conflict. What happens is people make a decision. They'll be like, I'm a position trader. They're trying to hold for 2 years. They want to hold during the bull cycle or whatever the case is. But then they get very emotional. They start out like lashing out, and then they turn into a day trader because they want quick endorphin rush fixes. I told one of my friends this. I was like, I've never seen a billionaire day trader in my life. I have never seen a billionaire day trader. And there's a reason for that. Anyone that really, really makes money are not thinking on short-term time horizon. They're all thinking long-term, right? So I don't believe in scalping, day trading, and swing trading. Although there's probably isolated situations where people do well with these things. From all of my experience of being in finance for 8 years, I personally don't believe they're profitable. I see the majority of the big winners in crypto acting like position traders. The majority of everyone I know that's rich, and a lot of them way richer than me, they act in 2 ways. They're either a business owner that's building wealth in crypto, or they're position traders. That's it. I don't even see the only investors we've seen are the people that bought Bitcoin at like $5. Like, can you be an investor? Yes, but I think position trading is more lucrative. So the reason why I sold all of my crypto and my assets is because I'm staying consistent to what I believe. Now, that doesn't mean that you might believe something different, but you have to pick. The problem is thinking that you're an investor, but then flipping to a swing trader and then flipping to a day trader and then coming back to a position trader. That's the problem. That's how you get wrecked. So everything I've learned in crypto for the past 8 years has led me to believe that this position trading strategy is specific to crypto. It is a crypto specific strategy. It is the best one. It's the most lucrative one. It makes the most money. I use fundamental analysis with the altcoins, and I use position trading. That's it. I believe it's the best. So all of my focus is on that. I don't look at the mainstream narratives. So I completely understand that the mainstream tells you to act like an investor. They tell you, oh, just dollar cost average and all this. And I have some extreme proof that that is not the case. It does not work. And you've probably seen some of my other videos where I talk about it. I don't believe investing in altcoins is a good answer. I think it's horrible. And it's probably one of the worst because these altcoins drop 98%, and to get back from a 98% drop, I think it's like an 1,800% increase you have to get. Like, it's absurd. It's not lucrative. It's just an excuse a lot of times, unfortunately, people use to not want to do any work at all. They want to just be able to buy assets and do nothing, and then feel great when the market goes up, and then all they want to do is essentially either, they just want to like brag, right? If you've seen it in crypto, they want to brag. They don't want to really do work. And so, again, which brings me to my ultimate point. We're going to finish up this video. I do not believe crypto is a get-rich-quick scheme. I believe it takes a lot of effort, a lot of work, and diligence, and it's difficult, and it's going to take you time. And I'm sorry that people sold you a dream, but if you believe this dream, if you continue to believe this dream, that it's not going to take discipline and excellence, then, hey, bro, you'll probably get wrecked and lose all your money like I did the first 2 cycles. But hey, that's my official thought process. You could do whatever you want. Have peace with your decision. At the end of the day, even my thing is irrelevant. God is in control of everything. So even my strategy is not over the peace of God. Like at the end of the day, the cream of the crop is Jesus. He even controls the Federal Reserve. Jesus controls the Federal Reserve. So like all of this is just like random, like like who cares anyways, right? I'm just telling you that as a trader, I'm staying consistent to what I believe. And as a position trader, I'm holding out and I'm being patient and I ain't buying nothing until I see my interest rate policy. And that might rub some people the wrong way and you might not like it. Hey, that's up to you. Do what you want with your investments. And I love you guys so much. Thank you for being a part of my entire community. I'll talk to you guys later. Peace out.